Hey, what's up, everybody? It's good to be back. I always look forward to getting with you guys every week and just talking about dividend stocks. I listened to my buddy Russ's live stream from last night. I listened to it today. I was not around last night, and evidently Monday night is my time slot. So there we go. We got that going for us. So hey, before we get started, you guys know that I do a little bit with bees. And so today I was putting together the frames that the bees actually draw out comb on. And so I bought the frames, which is just the wood part. And then on the inside of that is some plastic. That plastic is supposed to, be where the bees put out their wax, right, to fill up whatever they're going to put in there. So I'm doing that, and normally these frames will have two corners that are perforated and will pop off, and that allows the bee, especially the queen, to work her way around the frame without actually going on the outside of the frame. Because if I'm in there pulling frames and putting them back in and she's running around the side of the frame, might not end up too well for her. So if she's got a place to cut through from one side to the other without going to the outside of the frame, she's much safer. So I had 60 of those frames to do, which is quite a bit. And I looked at them and I was like, I don't see these perforations. So I had gone through assembling 45 of these things together. My fingers, because that plastic is rough, and my fingers, I feel like I've been playing the guitar, and I don't play the guitar, but I feel like I've been playing the guitar all day. So they're just basically raw. And so I got through 45 of those, and then I realized that I just didn't see the perforations. They were really there. So I ended up finishing the last 15 correctly. Then I had to go back and undo 45 of them, take those corners off, and then put them back together. So it's been a little bit of a frustrating day today, but I am glad to be here with you guys. And, I'm just looking forward to this. I love to hang out with you guys. So with that, the title of today's subject is JNJ, Johnson & Johnson's acquisition of, I got to find it here, hold on, of Shockwave. So if you're not aware, we have a Discord. And if you want to join the Discord, it's free to join. Just click in the notes to this video. Click and join the Discord. We'd love to have you there. It's a very serious-minded group of investors. And, sometimes we're serious, but sometimes we kick things around a little bit as well. And there's a category in there, or a channel, that is called Questions for Kevin, and it's spelled KWESTIONS, Questions for Kevin. And this question came out of that Discord channel. So if you're not a member of the Discord, we'd love to have you in there. Consider joining us on that. So here we are. Johnson & Johnson's acquisition of Shockwave Medical. Is this significant for Johnson & Johnson? And when I put this together, I had not listened to Russ's live stream last night. Sounds like he touched on this as well. So we will go through this. I'm going to go through it in a little bit more detail than Russ did. So put your seatbelts on. We'll try to go through it quickly. But here we go. On 4/5, Johnson & Johnson announced that they were acquiring Shockwave Medical for $13.1 billion. You can see that here. I'll see if I can't make that a little bit bigger for you. $13.1 million. This particular business would extend Johnson & Johnson's cardiovascular intervention, which has a very high growth rate. You can see here, cardiovascular intervention is one of the fastest growing global med tech markets. I've highlighted what I thought was important here. So Johnson & Johnson will expand its med tech cardiovascular portfolio. Cardiovascular is the heart, if you're not aware. and into two of the highest growth innovation-oriented segments of cardiovascular intervention: coronary artery disease, or CAD, and peripheral artery disease, or PAD. So we'll call them CAD and PAD. Shockwave is a leading first-to-market provider of innovative, I can't even say that, intravascular lithotripsy, IVL. We'll just call it IVL. How about that? Shockwave offers the only commercially available IVL technology. So that is, I think, a big deal. Shockwave also recently acquired Neovasc, a company that has developed the reducer system. And well, it's for angina. Yeah. So anyway, so that's the announcement that came from Johnson & Johnson. And since I've made this bigger, it's gonna. Here's some more things. They say the transaction benefits is that it solidifies Johnson & Johnson's medtech leadership in cardiovascular intervention. Again, it's the only commercially available one, and so it's going to make it a category leader in 4 of the largest and highest growth medtech markets within cardiovascular intervention. I think that's a pretty big deal. You come down here, it provides a robust pipeline for future growth in underpenetrated markets. And basically what they're saying there is that with the supply chain, or with the market chain of Johnson & Johnson, Shockwave's technology will be able to be dispersed along the already developed pipeline of Johnson & Johnson. So rather than having to build that pipeline themselves, they can take advantage now of Johnson & Johnson's pipeline. So that, I think, is great. It accelerates growth. But I do want to point out here, is it on this page or the next one? So it's going to, it's expected to become, this is important, it's expected to become Johnson & Johnson MedTech's 13th priority platform. And how they define a priority platform is any platform that brings in $1 billion or more in sales per year. So it's expected to grow at least to $1 billion. So that's a good thing. Here's something that we need to keep in mind. The very last sentence, and maybe they chose that on purpose to make this last, but considering the impact of financing costs, and they didn't disclose how much of this they were going to finance. That they did say it was going to be a mixture of cash and stock, but cash and debt, not stock, cash and debt, but they didn't say how much. But considering it is expected to dilute adjusted earnings per share by approximately 10 cents in 24, which is this year, and 17 cents in 25. So we'll talk about that in just a second. But let's look at some of the things. Simply Safe dividends. They basically reaffirmed. You can see that here. They reaffirmed on April the 8th that they have a 99. That's the highest score that Simply Safe Dividends gives. 99, very safe rating. You can see their yield is around 3.2%. Dividend growth is around 5%. Yeah, so we'll just kind of go through some of what Simply Safe said. I think Russ went through this. But if you didn't see Russ's video, then hey, hang tight, man. We're going to go through it here. Here's what I wanted to point out, though. Shockwave is projecting an increase in sales of around 30% to over $900 million this year. That is phenomenal growth. But it is equivalent to 1% of Johnson & Johnson's sales. So even a 30% growth in Shockwave is only 1% of sales for Johnson & Johnson. There's a couple more points here. One is that the dividend remains well covered. I think that's a great thing to know, even though there's going to be some dilution in earnings in 24 and 25. And overall, the transaction is really relatively small, representing just half of Johnson & Johnson's cash reserves, and represents a low-risk move into a strong market segment. So basically, they're saying that even if they paid all cash for it, it would only be about half of Johnson & Johnson's cash reserves. So, splitting that between cash and debt is just a financing decision by Johnson & Johnson. Okay, Simply Safe Dividends continues on and says S&P has lowered the outlook for Johnson & Johnson's AAA credit rating to negative following the news. So is that a big deal? So first of all, Johnson & Johnson has a AAA credit rating. There is only one other company, which is Microsoft, that has a AAA credit rating. The U.S. government does not even have a AAA credit rating. So what happens if they put them on a negative watch, right? Because they're going to be loaning more money. And what happens if they downgrade them? Well, next paragraph says, however, Johnson & Johnson will still boast an incredibly strong balance sheet and is only one of two companies. We already seen that at the very bottom here. Even if the company were to be downgraded to AA+, which would be the next rating down, it would remain on an exclusive list that includes only Alphabet, which is the new Google. I always call it Google, Apple, and Fannie Mae. So we have Microsoft and Johnson & Johnson with AAA. We have Alphabet, Apple, and Fannie Mae with AA+. So they're in the top 5 regardless. So does that matter for Johnson & Johnson? I don't think so. I don't think it matters. Okay, next thing is the elephant in the room though for Johnson & Johnson. And I don't think we want to get sidetracked. I don't think we want to follow the shiny object on this. The Shockwave is the shiny object. The gorilla in the room is the talc lawsuits. So I think we want to stay focused on the talc lawsuits. And well, let me just kind of walk through this because I got some points that I want to make at the end. First of all, Johnson & Johnson's total talc liability is expected to be around $10 to $15 billion paid out over several years. They have about $23 billion in cash. They have market-leading credit rating and retaining roughly $7 billion in free cash flow every year after paying dividends. So it looks to be a pretty manageable outcome for them if it ends up around the $10 to $15 billion range. Let's see. Overall, recognizing the upside from the firm's continued pivot into higher growth markets, coupled with its healthy payout ratio and strong balance sheet, we are reaffirming Johnson & Johnson's very safe dividend safety score. So that is from Simply Safe Dividends. I thought that was a very good write-up for them. Here's a couple of things in tip ranks that I thought might be helpful. The analysts, these are the top analysts, have an average price for Johnson & Johnson of around $175. So they believe in 1 year's time that the shares for Johnson & Johnson will be trading for around $175. That gives us, if that is true, if that comes true, which, we know that analysts picking the stock prices is very close to weathermen picking the weather. But if this were to come true, that would be about a 17% upside on the share price itself, plus the dividend. So that's not too bad. Then I looked at the insider buys and sells. There are some sells here, but it has been 9 months since anything significant. There was this one that was last month from an EVP, an executive vice president, that was an informative sale, but it was about at $1.4 million. And in terms of the number of shares that even the management team has, that's not a significant thing. So there's not anything really that I took away from the insider buys and sells, but I thought it would be helpful for you to see that. Then analysts remain cautiously optimistic about JNJ stock with a moderate buy consensus rating based on 7 buys and 6 holds. Over the past year, it's declined 5%, and the price target, and this was written actually at a different time, so that's why these numbers don't match. The price target was around 179, which gave about a 17% upside. So Morningstar says that Johnson & Johnson's trading at a 10% discount. It is they've got a fair value of $164. They believe that the growth potential of Shockwave will help accelerate the medical device segment by about 50 basis points, so about 0.5%. They expect we expect close to $1 billion in sales from Shockwaves in 2025, followed by rapid growth in subsequent years. I think it's not time for me to say what I think yet. So the economic moat they give as a wide capital allocation is standard. So the point is they believe it's a good deal for Johnson & Johnson. It's going to be a very small impact on them, and Johnson & Johnson's trading at a discount. I thought we would go to fast graphs, but man, it's already been 15 minutes. So what the heck? Let's go to fast graphs. It's not going to hurt anything. We'll come back to fast graphs because I would have to switch the screens. So let's go to the takeaways. Shockwave. First takeaway from me. These are my opinions on this. Shockwave may not be accretive in 2024, 2025, but their growth potential is very high. And so the question is, if it's not accretive in 24 and 25, did they pay too much? I would say they probably did, but my understanding is they had some pretty stiff competition for this particular company, especially from Medtronic was another bidder in the process. So I think Johnson & Johnson went in and said, we're gonna buy this company. And, I think they overpaid a little bit, but I think it was a good move for them. I think it fits well into their product line. The second thing, I'm going to reduce this back down so I can flip it from screen to screen. There we go. Love that. The credit rating for Johnson & Johnson may get lowered based on the financing used in the transaction, but even if it is lowered, they are still top 5 in the world. So I'm not concerned about that. The acquisition of Shockwave affirms the strategic view and actions of the management team. I think what we see here with Shockwave and its strategic fit and the strategic value that it brings to Johnson & Johnson, I think that's evidence, and it affirms to me the strategic viewpoint of the management team. So I find that to be a good thing from a management perspective. However, the Shockwave deal pales in comparison to the talc liability lawsuits. They are the biggest risks facing Johnson & Johnson. So I don't want you guys to get distracted by the shiny thing of Shockwave. Keep your eye focused on the talc liability. And let's see will the lawsuits be settled timely in the estimate range of $10 to $15 billion? That is the big question. If so, this news could cause a pop in the share price. If not, the share price could continue to be depressed. So I think what we're seeing here, and that's really all for the slides, but I think what we're seeing here is that Johnson & Johnson has made a good decision around Shockwave. So it's a great decision. I applaud the purchase. I applaud the acquisition. I think they paid a little too much, but I think the environment caused that. I think they had to pay what they had to pay. The thing we got to keep in mind of these talc lawsuits, that I believe is the uncertainty, the overhang of uncertainty around Johnson & Johnson. Is it going to be $10 to $15 billion? Who knows? We don't know. So with that uncertainty out there, I believe it is holding the share price down. I think if they were to come in soon with some kind of settlement, then it would take that uncertainty away and the stock price would move a bit higher for Johnson & Johnson. So with all of this, I decided that the price is down in the 140s, high 140s now. My cost basis is around 166. So I decided to pick up some shares of Johnson & Johnson today. I didn't pick up a lot, but I picked up enough to lower my cost basis down a bit and have a little bit more exposure to Johnson & Johnson. So I think it's a good long-term hold. I think that at some point, whenever they get to the place where they can resolve this talc issue, then we're going to see a bit of a pop for Johnson & Johnson. That's my opinion. You can take that for whatever it's worth. It is worth everything you paid for it. Let's just say that. Okay, so that's it on Johnson & Johnson. I am going to now go to the comments here. Let's see who's in the live stream tonight. John J. Good to see you, friend. Kevin, it's good to see you, my friend. I'm glad you're here. Pat is in the building. Good to see you, my friend. Brad Durfee is here. Kevin Mendoza. So we got at least 2 Kevins in the building tonight. So Kevin says, I need more dividends. So you know what? Let's talk about that here in a bit. I may have to get you to lay down on my dividend therapy couch. We'll have to talk about what that is. Why you worded it that way. Greg is in the house. Good to see you, Greg. Shaping is here. What's up, my friend? OJ. I'm sure there's a lot of jokes here, OJ. I'm probably going to pass them up, but who knows? I might not. Depends on how I feel a little bit later. So, but it's great to see you here, even though I heard of your demise this week. So, Michael Swami is in the house. He says, come on, take down your fishing pole and meet me at the fishing hole. You got it, my friend. All right. Jacob Harrison is in the house. Good to see you. Kenji is here. Man, that's awesome. We've got El Dynamico. Now, El Dynamico is from West Sacramento. And hopefully I described all of that well for you, El Dynamico, regarding Johnson & Johnson. There are words to that tune. Yes, sir. You know what, Michael? I wonder if you could send me a video of you singing those words. I would play that at the end of the live stream. You want to do that? Hey, I wouldn't do it, but if you want to do it, I will play it, my friend. So that's awesome. Shaping says he loves Johnson & Johnson because they bought back 7% of all their shares outstanding just in the trailing 12 months. They've got tons of cash. So that's good news. Looks like we have that one twice. So there we go. If Johnson & Johnson falls from their AAA credit rating, this is Michael, they might have the same credit rating as the people who can print money. I'm not even sure that it reaches that level yet, but they're on their way. Let's put it that way. Hey, we got Fenders 53. Mr. Income is in the house. Good to see you, my friend. Let's see. Oh, Christopher Dukes, welcome, my friend. Good to see you. Absolutely, it's a long-term hold. Yes, sir. Johnson & Johnson, I think it's a good long-term hold, at least for me, because, as you know, I'm retired, and I do need some what I call shock absorbers in my portfolio. So if you, if you're in the Discord, you see, every day some of us will post what our portfolio did. Most of the time, my portfolio will not drop as fast as the market, but it also won't increase as fast as the market because I have stocks like Johnson & Johnson who are in there as a shock absorber to kind of give me a lower beta for the portfolio. So, and I do that on purpose. So it is what it is. And I like that it's in my portfolio. Okay, looks like Kevin's got a question. Many plaintiffs in the talc lawsuit have now passed away. Okay, let me restart this again. Kevin, many plaintiffs in the talcum lawsuit have now passed away, so there are less payouts now. Well, that may be true, but if I'm not mistaken, those payouts would go to their estate. So I think, if there were any lawsuits that resulted in, caring for someone the rest of their life or something like that, that would cause that not to be there. But I think their estate would also, if the person filed for the lawsuit, then that lawsuit would be wrapped up in their estate upon their death. So I think the liability is still out there regardless. We've now got 3 Kevins in the house. Kevin Rayberg, Kevin Mendoza, and Kevin Burgess. So welcome. This is K cubed. So and he slipped in before the door is locked. Yeah, I never lock the door, my friend. I let anybody in. Um, so Jim says, I was hoping Russ stopped in. We told him in his live stream that you had an ending song, and he thought we were jerking his chain. Yeah, that's probably true. Uh, he's a busy guy. He's probably out welding something. So, I hope he shows up. But I did watch his live stream today, so it was kind of fun to see you guys talking about that. Thoughts on Devo? Well, let's. I tell you what, I'll take this one, and then I will move back to Kevin Mendoza. I want to put Kevin on the dividend therapy couch, and let's just have a discussion about dividends. And I don't know what I'm going to say about it, but I'll say something. But anyway, so let's see here. I'm going to remove this. Oh no, I'm going to stop that, and I'm going to present. What do I want to present? I want to present this window right here. All right, so there it is. Here we go. We're going to look at Devo. Let's take a look first at this at Simply Safe Dividends. And the reason I go to that is kind of like a I don't know, kind of like a crutch. But Simply Safe Dividends lays things out. It has a lot of information on one screen. And in a live broadcast like this, it makes it a lot easier for me to kind of look at the whole thing. There is no safety rating for Devo, which is Amplify CWP Enhanced Dividend Income. Looks like it's an ETF. I'm not familiar with it. Exchange traded fund launched and managed by Amplify Investments. The fund is co-managed by Capital Wealth Planning and Pensera Capital Management. It invests in public equity markets in the U.S. The fund invests directly and through derivatives in stocks. So it is a leveraged stock or a leveraged dividend fund. It uses derivatives such as options to create its portfolio. Market cap, and the fund invests in dividend-paying stocks of companies. The fund seeks to benchmark the performance of its portfolio against the S&P 500 index. So that's interesting that it's a high dividend, enhanced dividend income fund, but it's actually benchmarking against the S&P 500. So that's kind of interesting. And this kind of shows it. There has been a pretty slow dividend growth, and I think it's mainly because they are focused on the performance of the stocks themselves, maybe. But that's all it says. So yeah, it's got a dividend yield of 4.61%. Dividend growth is very slow. Low beta, though. It doesn't move around very much. Let's go into fast graphs. And oh, by the way, I mentioned that I would show you the fast graphs for Johnson & Johnson. Here it is. We'll go to 13 years. Fast graphs always has 3 years of forward forecasts. So I use 13. It gives me 10 years of history, 3 years of forecast. You can see the normal PE ratio is around 17. It is currently trading around less than 15 PE ratio. This is the cool thing. It's got a forecast calculator in it. If we were to go to the normal multiple here, and well, regardless, if it were to go to a 18.55 PE ratio over the 3-year period, that would give a return of about 17% per year. That's not too shabby. Even if it stays at, let me get rid of that. Even if it stays at a 15, here's a 15.18. If it stayed at a 15, it would give us about a 9% total return. I'm not too sad about that either. So anyway, that's Johnson & Johnson. We wanted to look up the Devo ticker. I thought I would just, oops, doesn't exist. So there's nothing out there for Devo. Let's go to, let's see what TipRanks has for it. Devo, there it is. Okay, so this is 1 day. It came down about 0.34% today. Let's look at the 12-month. looks like it is up almost 10%, so that's not too shabby. 3-year is 23%, so it looks like it's moving. 5 years 70%. So it looks like, Pat, that they are using derivatives to try and mimic the return of the S&P 500, not necessarily the dividend. And that's, to me, a little bit of a misnomer, because it looks like they are trying to have an enhanced dividend income fund, but they're really trying to mimic the S&P 500. And you can see it. I mean, that's a pretty nice return on the share price. So, it may not be too bad. I would want to do a lot more research, though. I'd want to look at their prospectus and see what their decision criteria are. But it's not been a terrible investment from a share price perspective. So, yeah, looks pretty decent to me, my friend, for whatever that's worth. All right, let's move on. Oh, I said we were going to put Kevin on the dividend therapy couch. So Kevin mentioned earlier, here, I'll go back up and find it. It's since the beautiful thing about having a small channel is that I can find these things. So Kevin Mendoza said he needs more dividends, and I would say, I think we would all want more dividends, but let's dig into that a little bit, because at the end of the day, it's really not about dividends for me. It's about total return. So when I look at a stock, I want it to pay a dividend, and I will typically not invest in stocks that don't pay a dividend. And it has to do more philosophically than anything else. But it doesn't have to be a huge dividend. It could be, Microsoft pays less than 1%, right? So I'm Microsoft's one of my largest investments, and so what I'm looking for is a total return. I'm looking for a return that's going to, give me a total return over a period of time. And so what I compare my performance to, the performance of what I call the Wealth Circuit Investing Portfolio, WCI for short, is I compare it to DGRO, and I compare it to SCHD. Those are the two. Those are two. One's a dividend growth fund and one's a dividend yield fund. And so I compare against both of those because I have a blend of that in my portfolio. And so, that's kind of what I look at. So, I don't typically tell myself that I want more dividends. What I look for are potentials for total return. So that's why I wanted to kind of have you lay on the couch for a little bit. And maybe if you want to give me some more thoughts on why you want more dividends, just dividends, because I've got some stocks that I think are good, high dividend yield players that also have a bit of growth. So, I have some stocks that have a higher yield, but I believe that they have some growth potential as well. And I have some stocks who are low dividend yield, but have a lot of dividend growth potential. So, if you're interested in some higher yielding stocks, give me a little bit more on what you're looking for dividends for. So hopefully that was helpful. That was just something that came to my mind. Let's see. Where did I leave off? I went back up. Thoughts on Devo. There we go. Oh, we got Suzuki Man is in the house. He didn't work last night, so he's probably getting a little bit tired now. He's normally a third shift kind of guy. Let's see. Mr. Income says for Kevin Mendoza, heirs will usually receive payments if litigation was in progress. This is a class action stuff. Yeah, that's right. I think it'll be part of the estate. And, just because the person passed away doesn't mean the liability is gone. So I think that's important to point out. Yeah, and Michael Swami has validated that. So I think we killed that. Well, we shouldn't have said that. I think we nailed that one. So, El Dynamico, which song? I'm not really sure. Oh, the song that I play at the end. You're gonna have to stick around, my friend. I'll play it for you at the end of the broadcast. I think you'll enjoy it. I enjoy it. Miguel Alejandro Fernandez. Good to see you, my friend. It is very nice when I'm able to catch the live stream, but when I'm not, I see the replay. I always appreciate your content, my friend. Well, I appreciate you being here. I really, really enjoy being around you guys. So, this doesn't get any better than this. I mean, we're kicking things around, but we're also growing our ability to look at stocks. And some of the things you guys bring up, like Devo, it's not anything that I've researched, but it's good for all of us to be in this particular venue. Yeah, Michael dropped it out there. Andy Griffith show tune, yes, sir. Oh yeah, yeah. Held down the Amico. He appreciates me describing things thoroughly. I appreciate you, my friend. Let's see. All right, John Jay's got a question. Do you like REITs like Ark and Main in an IRA? Yeah, I do. Now I have actually sold out of Maine. I did that several months ago. Not because I don't like Maine. I like Maine a lot. It is a higher dividend play, and I had a few of those in the portfolio, and it had run up so much, and my portfolio had just a very small position in it. So rather than hold on to that small position, I decided to sell out of the position. And if it came back down into what I considered a fun range to buy, I would actually get more serious about Main Street Capital. ARC is right behind it for me. It is, if I were to invest in two of these, what they call BDCs, business development companies, I would buy Main Street Capital, which is MAIN, and I would buy Ares Capital, which is ARCC. I would buy both of those. If I wanted two of those in my portfolio, those are the two. And I think I would put them in an IRA because, those dividends, especially if you're younger, those dividends would not be taxed. And so they would, how do I say that? They would be tax preferred. They would be either, if you're in a traditional, it would be deferred. And if you're in a Roth, it would be, you wouldn't have any tax on it. So depending on your IRA and how it's structured, would be, I think it'd be a good deal. Yeah, I wouldn't have any issues with that at all. So Brad loves Devo. Good to hear that, my friend. I may take a little bit further look into it, but I do invest. Oh, this is a rhyme. I do invest in VU. So, if it's really out there trying to mimic the S&P 500, I already have the S&P 500. So I'm not really sure if it would really kind of be a duplicate for me or not. So it would be something I would want to look at. Yeah, Shaping says, yeah, BDCs. Yep, that is true. So Mendoza says, I could use some dividend therapy. I can't stop buying dividend stocks. Yeah, so that's a great point. I love dividend stocks. Now, why do I love dividend stocks? I love dividend stocks because from a philosophical perspective, when a company pays its investors a dividend, it has a different seat at the table than a company that does not pay dividends. So for the management team every quarter, if they're paying a dividend out to the investors, those investors just philosophically have a different seat at the table with the company than companies that don't pay a dividend. Because companies that don't pay a dividend, I don't want to say that they don't really care about the shareholders, because I think they really do, but they're not sharing in the progress of the company with their shareholders. So I just think there's a different relationship there. That's why I first and foremost look for companies who are paying a dividend. And again, it doesn't matter to me whether it's 0.75% or 7%. I want to look for companies who are going to have a good total return in the long run. So let's see. Oh, as I see Jim Betts. So welcome, Jim. I don't think I've said hello to you yet. Can't speak for Kevin, but I have 291 shares of Maine, and they are my fifth largest position in my portfolio. That's fantastic. If I had had that many shares, Jim, I would probably still own it, to be honest with you. I don't remember how many I had at the time, but it was about 0.5% of the portfolio. And it was just, I went through that time where I had 42 individual holdings. And you guys, if you're part of the Discord and through the Buy Me a Coffee app, you know that what I do on a quarterly basis for my shares. So it was just too much. I had to winnow that down. And as of today, I am down to 24. So 24 holdings overall. So that is good for me. I'll tell you that. Maine has crushed ARCC over long periods. Yeah, that's very true, I think. Maine was my favorite. It is the only one that I had invested in. It was the only BDC that I held. And I like Maine a lot. But it had just run up so much that I didn't want to build a large position from a very small position at the price that it was at the time. Doesn't mean that I won't come back to it at some point, but and hey, what about Hershey? What about Hershey? Hershey today was in the low 180s. It was recently around 200. And, I thought I had missed the train, but I was patient. And so today I picked up a few more shares of Hershey. So loving the chocolate. Love it, love it, love it. All right. Let's see. John J. Holding those in an IRA is smart because you don't have to pay qualified dividends. That's exactly right. So for those of you who may not have any idea what Shaping just said there are two types of dividends. One would be qualified. One would be unqualified dividends. And So if a company pays qualified dividends, then you get it at the capital gains rate. And if they pay a non-qualified dividend, then it's at your normal income rate. So since the BDCs you would pay a higher tax rate on BDC's dividends, it makes sense to have it in an IRA. All right, let's see. Greg says that Maine is better total returns over ARC, even with higher dividend. That's true. Let's see. What else do we have here? So we got Maine is with a 6.14% dividend yield, but their special dividend payout makes it much higher. Yep, that is true. Are they very correlated? That's a great question. I don't know. And El Dynamico is pointing out that the Devo that we looked at a little bit earlier has a pretty high expense ratio at 0.55%. So thanks for sharing that, El Dynamico. That is good stuff. Michael Swami says, what are we? We are Devo. Maybe we're a diva. I don't know. So John Jay's got some V and Q as well. So that's good stuff. So Pat's thinking the same as El Dynamico. Let's see. Jim's got some analysis here. Let's test this out. Back testing ARC and Maine for the last 10 years through the dividend channel. Maine comes out ahead, but it wasn't an overwhelming advantage. Okay. Well, that's good. And if you were to look them up on Simply Safe Dividends, I think Maine is around a 61 or 62, something like that. And ARCC is around a 59. So they're, from a dividend safety perspective, they're not terribly different either. Oh, the Cookie Monster has arrived. I saw I should have saved it. I saw a meme today on about the Cookie Monster. And it had the Cookie Monster, and the Cookie Monster was really skinny. And it said the Cookie Monster's new weight loss photo after being on Ozempic. So I thought that was hilarious. All right, Mendoza. Thank you, Kevin. I enjoyed the dividend therapy counts. That was very helpful. Good deal. I'm glad. Oh, and let's see here. Tutomi has arrived in the building. It's good to see you, my friend. So welcome to the program. So it looks like we have a John J question. These are always really, I think he tries to stump me, which is not too hard these days. Since you're on the subject of JNJ, looks like they dealt well with their lawsuits. Do you see the same thing for 3M? I think is what he's looking at, 3M. Well, so first of all, I think 3M had a few lawsuits out there. One of them had to do with some environmental stuff, and one had to do with the the noise reduction earphones. And I think the environmental one was settled here recently. It was not catastrophic. It's something that they can manage as a company, but they have their lawsuit still out there. The one with the earplugs. So that's a big overhang for 3M. I'm not an investor in 3M because I think that earplug thing could be devastating for 3M, but it just depends. It depends on how they do. I mean, how big the lawsuit is settled for. I do like the way that Johnson & Johnson has handled their lawsuit from a shareholder perspective. Obviously, I would not like it if I were on the other side of that. But that's what courts are for, right? The courts, you have one position from the company and you have one position from the person who's been injured, and so there needs to be a settlement somewhere in the middle of that, and that's what the courts are for. So, let's let the courts do their work and see how it comes out. Hopefully it's in that 10 to 15 billion range, and then we can move on. So that's kind of where my head's at. Jacob, have I seen you tonight, Jacob? I think I did see you earlier, so it's good to see you, buddy. If y'all, and I love that, if y'all didn't have the internet, how'd you find stocks and learn about them? Was there magazine subscriptions? So I think Jacob's talking about back in the old days when folks like me and Mr. Income and maybe Pat and Jim Betts were, we were young and we were trying to buy some stocks. And, how do we research those stocks? Well, typically there was information that was produced by the company. Obviously, Sarbanes-Oxley hadn't come about, Enron hadn't happened, and so the information was less thorough, maybe, than it is now. Back in my day, it was less thorough. There were write-ups and analysis that was done by the individual firms. So we would call the firm, and then they would mail us, because fax machines weren't even then. So they would if we had to really kind of hone down on the stocks that we wanted to invest in, because we just couldn't look at everything. So we would do research, we would look at newspaper articles and things like that. And then every day there would be the tickers in the newspaper. And so you would basically follow the price of the stocks on a daily basis. I mean, today it's like every minute, every 3 seconds you're getting an updated ticker price. Back in our day, it was like every day you would see what the price was, and then they would still trade on the market. But when you put an order in, you really didn't know what the price was. So we would call our broker, and the the broker would actually get a brokerage fee. So if my memory is right, it was around $30 at the time, which was a lot of money. So if you were going to buy a stock, you couldn't buy little fractional shares, or somebody like me at that particular time, I couldn't buy 10 different shares, because I would have to pay $30 to the broker for every transaction. So it was, you had to be much more selective. So we would understand what stocks we wanted to buy. We would call the broker, and that broker would send us in the mail some information about the stock. So that's kind of how it happens. So I don't know. It seems like forever ago, and I guess it was, but the internet has changed everything. The internet has put everything at our fingertips. Any question that we have, we can get done, get researched on the internet. So it's a great deal. So great question, man. Uh, really good R pronunciations. Hey, thanks, my friends. Good to get to roll those R's every now and then. So Tutomi, buy this week more JNJ, my biggest position in my portfolio. I don't think in the long run, Tutomi, that we will be sad about that. I think when we do get the this overhang off of that, and again, I'm a long-term Johnson & Johnson fan, so I'm not trying to trade it. I'm not saying, hey, tomorrow, which is their earnings, by the way, their earnings are coming out I think before the market opens tomorrow. So I'm not saying that they're going to announce that the lawsuit is settled, right? I'm not buying it with the anticipation of a short-term settlement. I would love it if that happened, but I'm buying it because I think it's a good long-term investment. So that's all I got on that. Do I like Lilly? I do, but it's really pricey right now. I think they are the Ozempic holder. I think they own the patent for Ozempic, and everybody is pushing on that and buying those shares. And so I think they have really. I think we missed the boat. I think I missed the boat on that. Ally. Oh, sorry. I guess I should move the thing. Ally has nice patents. Is that Ally Bank? Is that what you mean? Or are you talking about Lilly? Maybe LLY. I think that's what you mean. Yeah, they do have some nice patents on those. Damn autocorrect. That's right. So you did mean Lilly. And yeah, they definitely have nice patents. That is absolutely true. I just find that all of those, I think Novo Nordisk, I think is the way you say it. I think both of them are overvalued from my perspective, and I just think I just got to the party late for either one of those. So I don't listen to I don't listen to those. I don't own either of those. So. All right, Slammer 6789. Glad you could join us tonight, buddy. Got here late. I made it in time for the Opie song. I'll have to watch the replay. I don't own J&J, but would like to hear your thoughts. Yeah, you did not miss that, my friend. It's coming up in about 8 minutes. So it's good to have you here. Let's see. All right, kind of working through some of this back and forth so that you don't have to. Let's see. Pat says, if you want to live off your dividends, at what age does the dividend percent mean more than the total return? Yeah, that's a great question. And I did a video on this probably about 2 years ago, and I did some math. I did some real math around dividend yield versus dividend growth. And I tell you what I came up with, Pat, is that and I used a high growth low yield, and I used low growth high yield, and it takes about, depending on which numbers you use, takes about 18 to 20 years for the higher growth lower yield to surpass the dividend for a high yield low growth company. And that's just thinking about the dividend. Okay, we're just thinking about the dividend at that point. But what you miss is the share price growth over time. So I think I would say when you get to maybe within 18 years of retirement, you kind of want to look at doing some of your investments in higher yielding stocks. That's what I do. And I've got I don't know, maybe 8 stocks that I have that are high yield. And but I think I approach it a little bit differently, and I don't think it's really about age. I think it has to do with retirement. So whenever you are going to live off of your portfolio, I think the at least the way I approached it was I said, how much do I need to live off of? How much income, therefore, do I need? Because if I'm going to have this much in expenses, I need to have tax covered, and so it kind of gets me a number that says I need this income coming in every month. That then helps me determine how much in dividends I would need. And so if you need a certain amount in dividends, then it needs to be a certain yield on average. And that's kind of the way I approached it. Hopefully that makes sense. But you may go look at that video. It's been a long time, maybe 2 years ago, but I still remember it because I worked really hard on it. So hopefully it helps, Pat. It's a good question, and it's something we all need to wrestle with. I wrestled with it and came down with I wanted to have two portfolios because I wanted in 20 years. I'm 58. So when I'm 78, I want my portfolio still growing. I don't want it to be a slow grower and with a lot of income. I want it to be a high grower with a lot of income. So anyway, that's kind of the way I look at it. Yeah, Michael says PFAS litigation and earplugs. He sold 3M as well. Years ago, he sold it. I think that's a good move. And let's see what else we got here. Oh, Jim's weighing in on Jacob's question, which is, how did we get our information back in the old days? And he says Wall Street Journal. I'd forgotten about that. And it was the hard copy of the Wall Street Journal, and it came every day. And so it had several sections, and I would always go to the business section. I think the library always had Morningstar books and Value Line. Oh, I forgot about Value Line. That was really expensive. So it's not a subscription that I could afford at the time. And so, yeah, the library would be the only place that I could get that. So, yeah, Schwab introduced $15 trading. I'm trying to remember who was the first to go free. I wonder if it was what's that one that all the young kids are using now? That's the one with the it's not coming to me. So, but yeah, I think you're right. I think Schwab introduced the $15 trading. Jacob says, I thought only rich people could invest until recently. I'm happy to learn that that's not the case. And it's interesting to learn how things worked. Yeah, that is a great point, Jacob. Investing is not about you don't have to be wealthy to invest, especially today. I mean, you can, my understanding is you can set up a brokerage account, really don't even have to fund it today. So then, once you put funds in it, then you can buy stocks. Those transactions are free. So, you can really invest with very little money. And I think we should do that. So if you're watching this and you are not an investor and you think you want to be, I would highly encourage you to get started. Let's see, Jim says when he first started, it was mutual funds. Then a lot of companies started having their own drip programs. That is true. Yeah, you still had to buy the qualifying shares through a broker, which sucked. Yeah, that's right. So, and mutual funds was a big thing. Then we did not have ETFs back then. It was only mutual funds. And so anyway, it was that's the good old days, right? All right, so we've got Fenders 53, Mr. Income. The earplug settlement agreement seems reasonable, but 3M does not have the cash flow or cash that JNJ has. Yeah, that's right. Have you ever considered starting a new position with UNH? Yes, I have. I've considered that, and I actually did that last week. I've bought twice, I think, UNH, and I think it has a. We're going to go a little bit over. Yeah. So, Michael, thank you. Robinhood is the one I was trying to think of. So I appreciate you sharing that. So let's look real quick, Tutomi, at UnitedHealth. You want to do that? So let's do this. And I'm going to remove your comment so you can see. Then let's do it like this. Anyway. Okay, so UNH. This is so as you know, United Healthcare had a bit of a challenge. With the Medicare rates that came in, and the government said they weren't going to raise the rates. They were only going to have a normal increase in the Medicare rates. That caused everybody to question the growth of folks like UNH, like CVS. I don't remember who the others were, but some of the other companies. So you can see, let's do, see, 5 days. That's not enough. You can see here that on March 14th, which was 1 month ago, it was trading at about 490. It is now down to around 445. Back in February, it was at 523. So it is now at 445. So it's been a pretty dynamic drop. I think the financials look really good for UnitedHealth. And I think that it's just a bit of being oversold. So I went ahead and started a position in United Healthcare, United Health Group, or whatever it's called, UNH. So yeah, have I thought about it? Absolutely. And I went ahead and actually did it. So I appreciate the question, my friend. Let's see, Schwab. Schwab was also the first to go to $29.95. Yeah, I remember that. So El Dynamico says E-Trade or Ameritrade were the first ones to introduce free trading. Okay. Well, see, I started with an E-Trade account that went from E-Trade. No, I'm sorry. I did not start with an E-Trade. I started once the internet came on, I started my internet account with Scottrade. And then Scottrade became a TD Ameritrade, then TD Ameritrade became Schwab. So I actually have a Schwab account with 1 penny in it. And so there's that. I read in the book about Warren Buffett in the Snowball that he bribed the guy that delivered the Wall Street Journal to drop his off first. So Warren got the Wall Street Journal 6 hours before the rest of Omaha. Wow. I didn't realize that. That was pretty good. So Tutomi starting to think about a position in UNH. I think it's a great stock with high growth. Yeah, that is actually one thing I wanted to point out. When we look at the analysts here, analyst forecasts, the analysts, that's all analysts. We'll pick the top ones. Wow, the top ones are even higher. So their top analysts on tip ranks show that in 1 year's time, March of 2025, they're expecting the stock to trade between a low of 549 and a high of 643. So on average, it's $599. That is roughly a 34.45% upside. It is the stock in my portfolio now that has the highest potential upside from an analyst perspective. And again, like I said earlier, you get about a 50-50 shot there because it's like predicting the weather. But I think it's a good stock to take a bit of a gamble on. I think it's going to be a long-term holding for me, but I do believe it is going to move up in the next 12 months. So I'm excited to have that in the portfolio now. And Michael agrees on UNH. So that is awesome. Well, you guys are incredible. I really enjoy our times on Monday nights. So it's too bad my buddy Russ couldn't make it because we are about to play our fun theme song closing. So with that, I'm going to get off of here and let you guys back at it. So I will see you again next Monday night. So, keep putting those questions and the questions for Kevin in the Discord. I look through those and determine what the subject's going to be for the live stream from that Discord channel. So look forward to seeing you guys, and I will see you on the next one.